How's it going? It's Ron with Abiera Team Real Estate, and today I'm going to talk about a hot topic that a lot of my clients are asking me about, and that has to do with temporary mortgage rate buydowns. So let me break it down for you. I'm going to define it and let you know if it's going to be a benefit to you. Let me start off by giving a caveat that I am not a licensed mortgage professional, so please take what I'm going to tell you with a grain of salt. Keep in mind though that I am a realtor, so I speak with mortgage professionals on a daily basis. And in fact, the information that I'm going to share with you is coming from a mortgage professional that I trust. So here we go. Let's talk about what it is. So a temporary mortgage buy down, you'll hear of things like a 2-1 arm or a 3-1 arm, but basically you're paying to have a lower rate for a certain number of years, and then it'll get back to your par rate. So the big question is who's actually paying for that. So I'll talk about that here in a second, but let me just give you guys an example. So a 2-1 arm. So let's just say that the par rate is 7.5%. That means that for year one, your mortgage rate will be at 5.5%. Year two, your mortgage rate will be at 6.5%. And then year three through 30, it's going to be at that par rate. With this example, let's just say that's 7.5%. And so basically what it's doing is it's giving you sort of temporary relief of a lower payment until you get to your par rate starting at year 3 in this example. And that's going to be different from a permanent rate buy down, where once you pay to buy down your rate, it's going to be that rate for the life of the loan. Let me give you guys an example and sort of kind of break this down with some numbers so hopefully it'll make a little bit more sense. So here is the example, is that we have a home with a purchase price of $1 million. The par rate is going to be 7.5%. Let's just use that as an example. And the borrower is putting down 20%. So scenario one is that the borrower does no rate buy down. So at 7.5% for $1 million purchase with 20% down, your principal and interest payment is going to be about $5,600 a month. So just keep in mind, in this example, I'm just talking about your principal and interest. I'm not taking into account your taxes and insurance. So your principal and interest is affected by the interest rate. So just keep that in mind. So again, scenario one, no rate buy downs. Your monthly P&I payment is going to be about $5,600 a month. Scenario number two, let's talk about a permanent buy down. So the cost to get a permanent buy down, let's say if the par was 7.5 to get put to 6.375, the cost is about $20,000, and that would get you that rate, and your P&I payment is going to be about, let's just call it $5,000 a month. So in that scenario, what you would have to calculate to see if this is going to make sense for you is you take the cost of that rate buy down, which just call it $20,000, and the monthly savings would be about, let's say $1,600. Let's just call it $1,500. It's what you're saving every month with this rate buy down versus if you didn't buy down the rate at all. So I haven't done the math, so I don't know, but just so you guys can calculate, just take $20,000, divide that by $1,500 a month, and that will give you how many months it's going to take for you to break even. And after that is when you actually will see benefits from this rate buy down. So again, without even knowing the math, let's just say it took 2 years to realize that $20,000. So in that example, starting after year 2 is when you would actually benefit from that rate buy down. Okay, so that was scenario number 2. Scenario number 3 is, let's talk about this temporary rate buy down. So the cost to do the temporary rate buy down for a 2-1 arm is going to be about $20,000. So it's kind of apples to apples with scenario number 2. So for $20,000, year 1, your interest rate is going to be 5.5%, which has a monthly P&I payment of about $4,500 a month. Okay, and that's good for 1 year. The second year, you're going to be at 6.5%, and your monthly P&I payment is going to be about $5,000. So starting year 3 through year 30 or whatever the the terms of that loan is, it's going to be at that par rate of 7.5% at about $5,600 a month. That is the temporary rate buy down scenario. The question is, how is this going to be beneficial, or what is the scenario that somebody would want to do a rate buy down? And just off the top of my head, I'm trying to think, who would want a temporary buy down? Obviously, somebody wants a lower payment, but we know that it's temporary. So who would want to do it for only a couple of years? One is if you're planning on selling in a couple of years, maybe that might be one where you just want the lower payment and then you're going to move in a couple of years. Scenario number two might be you anticipate the rates to drop. And so for the first couple of years, you want to pay as little as you can and then refinance at a future time, hopefully by year 3. And then the other scenario that I could think of is if you anticipate an increase in your income. So let's say you've got a promotion that you're anticipating in a couple of years. So you know that your income is going to increase, or you have a spouse that's either currently not working and in the next couple of years you plan on having a second household income, then that would prepare you for that higher mortgage payment starting year 3. So those are the scenarios I can think of at the top of my head. Basically, it is a temporary lower payment. And I think the only way that would work is if somebody else is paying it. So I'll talk about seller paid credits to allow you to buy this rate down. I think that might be the only time that it would make sense if somebody else is paying for it. So let's break this down on how this is going to benefit you as a buyer and a seller. So let's talk about the buyer. If you're a buyer, how you should strategize taking advantage of whether it's a temporary buy down or a permanent buy down is that it's going to cost. In this scenario, it's still $20,000 real money is being paid to get the rate manageable or basically lower. So my advice is, depending on your market, especially if things are slow in the area and the price range you're looking at, is to consider negotiating to get the seller to pay or give you a credit towards your buy down. It's the market, things have slowed down. Definitely take a look at adding that as part of your negotiation is to get the seller to give you a credit to help ease your payments as you get into a home, especially in this price range. Another perspective we need to look at is from the seller. So what is this whole rate buy down, how does that affect you if you're thinking about selling? One is that now that we know that the market is slowed down, is to consider offering this to a buyer. Again, the scenario is you've been on the market for a long time and you're considering a price reduction, which a lot of people are. So in this scenario of $1 million home that you have on the market and it's not moving, you're trying to attract more buyers, and you know that a price reduction is inevitable. Instead of, or let's say in addition to lowering your price, consider offering a rate buy down to a buyer. So if you're at $1 million and you're thinking about reducing your home 5-10% to get in line with what's happening in the market in your area, so instead of lowering your price $100,000 or $50,000, why not lower it $20,000 and also offer a rate buy down? That might be sort of enticing enough for a buyer to consider your home. What would be really baller of you as a seller is to offer that right from the jump. Incorporate that in your marketing as you put your home new on the market. And the reason why I say that is because a lot of new homes are doing that now. So you look at the marketing, what new home construction is doing, they're offering their product. Hey, you can get a new home as well at this price, as well, and all the upgrades, as well as an interest rate of, as an example, 5%. And how are they doing that? They've already calculated what it's going to cost to get to that rate. So be pretty intelligent of you as a seller in this market to incorporate the same idea in your marketing. Hey, you already know it could cost, as an example, $20,000 to offer that to a buyer for a rate buy down, whether it be temporary or permanent. Let that reflect in your pricing and offer that as an incentive for a buyer to take a look at your home. Anyway, those are my thoughts. If you guys have any further questions about mortgage rates or how to navigate in this market, definitely reach out, and I look forward to helping you guys out. All right, take care.